Did you know that a smart auto rebalancing app can create taxable gains for retirees, even raise Medicare premiums later through IRMAA? Today is a showdown. Bogle versus AI. Old school investing wisdom versus modern automation hype. And here's the conflict in one sentence. Automation can save you from drift, or it can create invisible churn that quietly costs you money. Hey everybody, this episode is educational content. It's not personal financial advice. I don't know your own full situation, and I would suggest that you consult a qualified professional before acting on any strategy. I'm 67 and my own target mix, and let me repeat that, that's my own target mix, is 60-40. 60% equities and 40% bonds. And how did I get there? Well, I'm big into simulation. I've run multiple back tests, stress tests, and Monte Carlo tests. And that's how I came by the 60-40 balance, which works for me. The framing is reasonable for many retirees in their late 60s, but personal circumstances differ, obviously. I mean, we could be looking at pensions, Social Security, spending needs, risk tolerance, and of course, the big T, taxes. And they all matter. Here's my promise for today. By the end of the episode, you'll have a one-page rebalancing rule you can run yourself, plus 5 audits that expose whether an automated platform is helping you or overtrading you. In 1975, there appeared on the scene rather slowly a gentleman by the name of John Bogle. Some call him Jack Bogle. As a matter of fact, he founded Vanguard in 1975 and became the leading voice for low-cost index investing for everyday investors. His core message, well, it was simple. Control what you can, which would be control costs, diversification, behavior, and stop turning investments into a constant activity. It's not a sporting event in the Olympics. Bogle also warned investors not to peak too often. The more you stare at markets, the more tempted you are to react emotionally. Rebalancing is a useful tool, no doubt, but overdoing it can turn into the very tinkering Bogle spent his entire career warning against. I'm going to keep these episodes very tight, and each segment is going to be a unique takeaway. So let's jump into rebalancing, which is the process of bringing your portfolio back to its target mix. I'm sure most of you have heard about this by now. And if you haven't, that's fine. If your plan says 60% stocks and 40% bonds, and after a rally you drift to 70-30, rebalancing means trimming stocks and adding to bonds until you're back at 60-40. Notice what this always implies. You sell some of what that went up and you buy more of what lagged. Rebalancing is not prediction, and it is not timing. It is risk policy that keeps your portfolio aligned with what you intended to own. Bogle was never saying, don't rebalance, but he was warning against turning investing into a daily hobby. 2 things quietly destroy outcomes: behavioral mistakes and unnecessary friction. Friction includes fees, spreads, taxes, turnover, and constant tinkering that feels productive, but I can assure you that it's not. Stay disciplined and do not stare at your portfolio so much that you start freelancing. Money compounds slowly. Time depreciates rapidly. I'm 67. I use a 60-40 equity bond split because it's designed to do 2 jobs at once for me. Job 1 is long-term growth through equities to help fight inflation. But job 2 is stability through high-quality bonds to reduce volatility and provide ballast when stocks drop. A balanced mix like 60-40 has historically delivered a strong long-term return with lower volatility than an all-equity portfolio. The exact numbers vary by period and index, but the trade-off is consistent. Fewer extreme drawdowns in exchange for giving up some upside. Look, this is not a one-size-fits-all situation. Some retirees have strong pension coverage and can hold more equity. I've got a lot of my friends that are military, and they fit squarely into this category. Others need more stability. The point, and that's me, by the way, the point is to choose a target that you can live with. Then manage drift so that the market does not silently change your risk level. In retirement, the order of returns, they really matter. A severe drawdown early in retirement can do more damage in the same drawdown later because withdrawals can lock in losses and shrink the base that future compoundings they depend on. And this is exactly why drift is so dangerous. After a long bull market run like we've been having recently, a balanced portfolio can become far more equity heavy than you intended. It feels good on the way up, but it increases vulnerability right when you're relying on that portfolio for income. Here is a simple gold standard for retirees. Check it once per year and use tolerance bands. If your target is 60% stocks, a simple starting point is a 5-point band. At your annual review, do nothing if the stocks were between 55 and 65%. Above 65%, you trim stocks and add to bonds. Below 55%, you add to stocks from bonds. This approach avoids overtrading, keeps risk from drifting too far, and gives you a written rule so you're not making up a new plan in the middle of a storm. By now, you probably have a question, and that question would probably sound like this: can I do this myself? For most people, that answer is yes. The majority of retirement portfolios can be handled with this basic construct: a diversified stock sleeve, a diversified bond sleeve, a once-a-year check, and clear guardrails. Most problems happen because people never wrote the rules down and then improvise when markets get a little bit rough. If you can state your target mix, review it annually, rebalance inside tax advantage accounts, and follow the rules when markets are euphoric or scary, you can usually run this policy yourself. Complex tax situations, concentrated stock portfolios and positions, or estate planning, well, those may admittedly justify professional help. So most AI platforms today are not predicting markets with deep learning algorithms. Most are rules-based automation, predefined triggers that monitor drift and execute trades. That's fine as long as the rules are sensible. The danger is a black box that trades repeatedly when you do not understand what the triggers are. It can keep you disciplined and it can prevent drift. And to be clear, I am not anti-AI. I use AI tools myself to fact check and tighten my scripts. The issue is not AI though. The issue is letting any black box make repeated decisions with your retirement money when you don't understand the rules it's following. Here's a concrete example of how rules change outcomes. Some platforms set a drift trigger like this. If your stock target is 60%, they rebalance when you drift to 63% or down to 57%. That'd be a 3-point drift. Compare that to a 5-point band. You do nothing unless your drift hits 65 or 55%. In a choppy market, that difference can be the difference between a few adjustments a year and a constant trim and top off cycle. And that's exactly what I'm getting to. My baseline for retirement is simply, I check once a year and I only act if I'm outside of my 5-point band and I'm not chasing every wiggle that comes down the market. Now, we add the retirement reliability. Okay, now let's add the retirement reality. When taxable accounts are involved, more trades can mean more realized gains. And in retirement, a tax hit is not just a tax hit. It can also push up modified adjusted gross income and trigger IRMAA later. Why? Because Medicare uses their wonderful 2-year lookback, which I've actually committed an entire episode to that. First, let's talk about bands that are too tight. Some people, believe it or not, have a 1% band. And it's not just a little stricter than a 5% band. This is a completely different strategy. and it can create turnover in volatile markets without improving net incomes. Second, wrong account order. Best practices is usually to rebalance in tax advantage accounts first, IRA or 401k, where trading does not create capital gains. Taxable should be last, and only when necessary. Otherwise, you can create needless taxes possible and IRMAA fallout later. Third, and that would be not using cash flow balances first. The best rebalancing is often invisible. Take withdrawals from the overweight side, direct dividends and deposits to the underweight side, and reduce selling. This is where my bucket system helps with execution. I think less about trading and more about routing cash. When equities are overweight, I can move value from one growth bucket to my IRA cash bucket. Still inside the retirement account world where trading does not create capital gains. Then when I need spending cash, I distribute into my taxable spending bucket based on my plan. Same outcome as rebalancing with fewer trades and way less temptations to tinker with your portfolio. Ask any AI platform these 5 questions. If you cannot get clear answers, you're dealing with a black box. 2, is it monitoring daily or effectively trading frequently? 3, what is the account order logic? IRA, 401k, taxable, etc., etc. 4, does it use cash flows first, withdrawals and deposits before selling? 5, does it snap back to target constantly or allow a sensible range? The simple context of this episode is simple. It's old versus new. It's Bogle versus AI. It's old school wisdom versus modern automation hype. The goal is not activity. The goal is outcomes after fees, after taxes, after friction. And for retirees, outcomes can also be after Medicare premiums if IRMAA gets triggered. For most people, the winning plan is boring on purpose. Pick a target mix you can live with. Check once a year. I use 5% bands. Use cash flows first. Rebalance in tax advantage accounts first. And use taxable last only when necessary. Everybody, I appreciate your comments and your ideas for future shows. That's where a lot of my shows come from, is from the comments below. As always, health is wealth and wealth is freedom. Now let's get busy living. Thanks for listening to me. Have a great day.